Hi, welcome to Investing in Data, a channel dedicated to using data to answer questions related to investments. Right. My name is Sonny. I'm a data scientist and I'm also an active investor and trader. I'm going to use data to answer fundamental questions that I see people asking me most often. I speak with a lot of retail investors, and one of the questions that they always look for answers to is which is the right stock to invest and when is the right to enter, right? So they're very much paranoid about selecting stocks, right? And in this video, what I'm going to show you is stock selection is actually not much an important process to generate returns, and that might sound counterintuitive, right? But I'm going to show you at the end by this process, I'm going to show you how and why actually stock selection is an overrated process. You can go very simple in your process of investing. I think I want to bring back the focus on investing process and not on the underlying assets that you're looking at, right? I think I want to simplify the process. So we're going to use a programming approach to explore data. We're going to do live, you know, an analysis of data to understand those patterns and figure out that. So this discussion is going to be understanding whether selecting stocks is so critical to make money in the markets. So, welcome to this series. Hope you will like it. Let's begin. What we're going to do is we're going to select five random stocks, okay? And that's from the Nifty 100 list. So, from the Nifty 100, we're going to select five random stocks. And on any random date between this period, so between 2017 to 2022, we're going to select a random date and we're going to select five random stocks from Nifty 100. Right? Basically, it's like you wake up on a day and you just select any five stocks from the Nifty 100 list, and then you're going to invest. Well, let's say 1 lakh rupees. Yeah, this is just for simulation, doesn't matter. So we're just saying 1 lakh rupees. We're going to invest into each and every of those five stocks, and we're going to exit after exactly a year. So for the sake of simplicity, I'm not doing it for a specific year. I just want to create, pure randomness. That's why I'm saying any day we wake up, select five random stocks, select invest 1 lakh into them, and exactly after a year, we exit. Okay, and this is one simulation. So this entire set is one simulation that we are going to do, right? Now we want to we want to repeat this multiple times. So we're going to do 200 simulations on this, and then finally we're going to look into the results, right? So this will give us a view into how does it look like? Does the randomness create any results? So let's dive in. We're going to
Yeah,
look into Python code for doing the simulation. Um, so let me walk you through this. By the way, all of this code is available on GitHub. So I will put that link in the description for you to get access to this code. So I will walk through this. If you're not a developer, you'll still be able to understand what it does. And if you're a developer, that's going to be easy for you. So this is the part where we import a bunch of functions, some libraries that we need. We need access to historical stock price data, and for that we need, and you can't do this manually by downloading prices, so you need API access. I use the Fires API, and here's the documentation for that. Fires is a very popular stockbroking firm, and they offer APIs which are completely free for end user usage, and these APIs give you access to real time as well as historical price data. So you could use these APIs to access any stock price data in real time as well as historical, right? So very useful if you want to build any kind of strategy, right? So you this I put the link in the description. With that, you can open an account with Fire, so you don't already have it. And after that, you need an app ID and an access token, which you need to paste it here. After that, we will pull the prices. I have a function here which is called the get price, which takes in three arguments, which is the symbol, the from date, and the to date. It's very simple. Let me just explain to you what this function does. It takes a symbol and a start date and an end date. It calls the APIs and gets the price of that stock during that date. Okay, and it gives you a result like this. Let me show you that part here first. So I am calling this function, I'm passing it TCS, and 1st Jan 2016 to 10th December 2016. So you get a response like this. You can think of this like a spreadsheet, like an Excel sheet, where you have the dates and you have the open, high, low, close volume, right? So the daily candles are coming up here, right? So this is very powerful. If you want to build something where you want to explore historical or even real-time data, you can use this, right? I hope you're getting to understand how this could be used, right? I have one more function here which generates the Nifty 100 stock list. Basically, there is a CSV file which I've also linked here on the NSC website, which you can download, and that has the list of all the symbols. So, for example, these are the Nifty 100 as of today, the companies in the list, right? So, for this simulation, I've taken the large cap companies, but you could also experiment this with small cap companies, right? Let's go. Let's go. Okay. I have one more function here which says did stock undergo split. Now this is important because B there might be a stock in your simulation which has undergone a split. So let's say if a stock undergoes a split of, let's say, one is two, the day the split happens, the stock prices will look like 50% down. Now, there is no stock change as such. I mean, there's no market cap change. It's just that the price has been halved, and the volume is doubled, right? So technically, there is no change, but our simulation might consider that as a loss of 50% value, right? Which is not correct. So for the purpose of simplicity, what I'm doing is I have a function which will compute the change in the price. And if it is more than 50%, it will consider that as a probably a split change, and it's gonna remove those stocks from the simulation, right? So, for example, if I ask this question, is and this dat is for TCS, so it's going to say, did TCS undergo a split during that time? It says false, which means no, it did not undergo, right? Coming later, now that's the most important part, the simulation, right? The simulation is a function which is going to be, it's an algorithm which is going to do the simulation, right? So what do we do? We select a random symbol. Remember what we talked about in the initial slide, right? We select a random symbol from the Nifty 500 and a random date between 2015 to 2022. Okay, so this is the period between 15 to 22. Any random date in that year is selected, and then we look over 1 year period, and then if we compute what was the price on the date that we selected for that random share, and after a year what was the price. So based on that, it will compute the number of shares, and it will compute the return that you would have made from those shares, right? It could be positive or negative, right? So for example, we could run it once. By the way, I've defined two parameters here. One is the investment per share, which is 1,000, which is 1 lakh, and the number of stocks, which is 5. You could change this if you want to, but 5 is a reasonable number, right? So when I run this once, it took this 5 stocks: Maruti, M&M, Exceltech, Access, Havels, right? As you can see, there are 5 different stocks selected on different dates, right? So if you run this again, you'll get a different list, right? So every time you run the simulation, you're going to get a different set of stocks and dates, right? And that's the randomness that we're talking about. If you look at the output, what it will tell you is every share that it traded, what was the, simulated, not traded, simulated, what was the dates, and what was the entry, exit, and how much money did it make, right? Conceptually. So if you add all this return, you can get the net return of this 5 shares, right? So that's what I'm going to do. I'm going to compute the sum of the returns, and I'm going to divide it by the total investment, which is 5 lakh, for example. So this gives me 13% return. So this simulation made a 13% ROI on that investment in that period, right? Now, now this 13% is coming from a random set of simulation, but if we were to do this multiple times, you would realize that what could be, what numbers can we look at it, right? So because you may not get 30% every time, right? To remove the element of luck, we so what I've done is I'm running of 200 simulations. So for 200 different times we're going to run simulations, and every simulation will have its own, its unique set of combination of 5 stocks and on a different set of dates, and it's going to compute the return. So it's going to store this. By the way, these returns are also stored. So if you go to GitHub, you will see there's a simulation folder where you will have all the simulation files getting stored. So if you open any of them, you can understand on those stocks what was the entry and exit and what was the return that it made, right? So that way we can later on track that. So this 200 simulations, but then you could do it for 2000 also, or 20,000, right? The more simulations you do, it's better, because then you are removing any element of luck, right? So this is the output. As you can see, these are all the simulations that it has run. Every simulation will have a different set of stock symbols. As you can see, it's from different industries, different segments, and that's because that's how we have designed it, right? So let's go. Okay, now the most important part. We're going to look into the returns that we saw from those 200 simulation and see a visual plot, right? And in the next part, I'm going to deep dive into this distribution plot, which is the most important outcome of the simulation. So, what is this plot? This is showing the ROI of those 200 simulation that we did, right? Now, these red lines that you see, these cover the one standard deviation region of this plot. And for people who don't remember what is one standard deviation, it basically covers 68% of your data, right? So roughly two-thirds of your data is in that region, which means that there's a two-third probability that if you were doing this, you were going to be in this region, which means between 0 to 50% of return is what you could make. And you see the majority, the mean is somewhere here, which is around 25. So on an average, if you have done this, you're going to be ending up on a 25% return in a year, right? If you look at it from an absolute perspective. Now, this is a very interesting finding, because people have a perception that if you don't get the right stocks in which you invest at the right time, making money in the markets is going to be difficult. Whereas if you look at this report, what it is saying is, it's not like that. Investment in general, in the long run, make money, right? And it's not about which stock do you buy in. It's about, are you there? Are you there being part of the markets, right? And that's what is the key takeaway from this, right? If you see, of course, if there will be bear markets when the market won't go up, right? But you don't know when that is going to happen. So being part of the system is what is more important, right? And if you and to understand why this happens is because if you look at markets in a growing economy in the long run tend to go up, right? Which means the value appreciates in the long run, right? So by being part of the market and being long in the market, you have an opportunity to make money. And that's what simulations is. There's a larger probability that you end up making money. This is counter to the fact that most people think making money in the markets are risky and they don't actually happen, and NFTs are better and things like that, right? So, and I think this is the most important part of this simulation, that it doesn't matter which stock do you enter in it. What matters is, are you there, right? I'm repeating this again, it's very important, right? So let me quickly summarize the key takeaways from the simulation. Thank you. So we are in the last part of this session. Now, hopefully, you've made up to this point. So, what are the most important takeaways from this? The takeaway is not that you should invest in random shares on random days. No, that's not the takeaway. The takeaway is, it is not important to be so prudent about which companies and stocks to invest in, right? What is more important is, are you investing, right? If you're not investing, you don't make money, right? So being part of the system, being invested is the number one key takeaway. If you are there, you're going to make money, right? So the takeaway is, stay invested, and the best and the easiest way as a retail investor to get into this is through an SIP, which will help you create the habit of disciplined investment, right? And so that's the most important thing. And second key takeaway is, because stock selection is not much of a big problem in terms of the basic, I would say, the basic idea of making money, right? You should stay away from any kind of tips or recommendation that come to you from unauthorized sources, right? People who are not qualified or authorized to do that. Don't get into that unless you are invested into, unless you have partnered with a portfolio management company whose core business is to do that kind of analysis and recommendation. Don't get into any kind of recommendation from tips, and rather you're better off just doing it in the markets, right? And what I will do is, as a follow-up sessions, I'm going to talk about at what point, how does it make, should you invest in a mutual fund which is on the index, or should you go into a specific company and stock? And at what point do how much diversification is actually going to be similar with the returns that you get from a index, right? So maybe I will build another simulation on that. And if you have any ideas on any kind of questions that you want me to answer by using data and simulations, please write those in the comments, and hit subscribe if you think this is useful for you, so that you get to know about the other content that I create. And I hope that there's something that I was able to kind of share with you, and I think it was helpful, right? Thank you for all your time. Bye bye, take care.